Welcome to SG Investment. Our channel is dedicated to helping you make informed decisions about your money and to guiding you on your journey towards financial success. Subscribe now and join our community of like-minded individuals on the path to financial freedom. What is investment? Investment refers to the act of putting money into a financial vehicle or asset with the expectation of earning a profit or capital appreciation. Investments can take many forms, including stocks, bonds, mutual funds, real estate, and more. The goal of investing is to generate income or capital gains over time, while also managing risk. Different types of investments come with varying levels of risk, and investors typically seek to balance their portfolio by including a mix of assets that offer different levels of risk and potential return. It's important to carefully consider your investment goals, risk tolerance, and financial situation before making any investment decisions. What are the basic investment types? There are several types of investments that individuals can choose from, each with their own set of risks and rewards. Some common types of investments include 1. Cash equivalents. These are low-risk investments that can be quickly converted into cash, such as money market funds or short-term government bonds. 2. Fixed income securities. These are investments that pay a fixed rate of return, such as bonds. 3. Equity securities. These are investments that represent ownership in a company, such as stocks. For real estate, this can refer to physical property, such as a rental property, or a financial investment, such as a real estate investment trust, REIT. 5. Commodities. These are physical goods that are traded on markets, such as gold, oil, or agricultural products. 6. Alternative investments. These are investments that do not fit into the traditional categories of cash, fixed income, or equity, and can include assets such as art, collectibles, or private equity. How can I start investing? There are several steps you can take to start investing. 1. Determine your investment goals. It's important to have a clear understanding of your investment goals, such as saving for retirement, building wealth, or generating income. This will help guide your investment decisions and determine the types of investments that may be suitable for you. 2. Assess your risk tolerance. Your risk tolerance is your personal willingness and ability to handle the ups and downs of the market. It's important to understand your own risk tolerance and invest in a way that aligns with your goals and comfort level. 3. Create a budget. In order to invest, you'll need to have some disposable income that you can set aside for investing. Create a budget to determine how much you can afford to save and invest each month. For open an investment account, there are several types of investment accounts available, such as individual retirement accounts, IRAs, employer-sponsored 401k plans, and taxable brokerage accounts. Choose an account that aligns with your investment goals and risk tolerance. 5. Choose your investments. Once you have an investment account set up, you'll need to decide how to allocate your money among different asset classes, such as stocks, bonds, and cash. You may want to consider seeking the advice of a financial advisor or professional to help you make informed decisions about your investments. Start investing early, keep investing regularly. Starting to invest early and investing regularly can be important for building wealth over the long term. Here are some reasons why. 1. Compound interest. The earlier you start investing, the more time your money has to grow through compound interest. Compound interest is the interest earned on both the principal amount of your investment and on the accumulated interest. The longer your money is invested, the more compound interest it can earn, which can result in significant growth over time. 2. Risk tolerance. When you're young, you may have a longer time horizon and be able to afford to take on more risk in your investments. This can provide the opportunity to potentially earn higher returns, which can be beneficial in the long run. 3. Dollar cost averaging. Investing regularly, such as through a systematic investment plan or dollar cost averaging, can help to smooth out the impact of market fluctuations on your portfolio. This can be especially helpful in volatile markets, as it allows you to buy more shares when prices are low and fewer shares when prices are high. 4. Habits. Getting into the habit of investing regularly can help you build a strong foundation for your financial future. By making investing a regular part of your financial routine, you can set yourself up for long-term financial success. Conclusion. In conclusion, investing is the act of putting money into a financial vehicle or asset with the expectation of earning a profit or capital appreciation. There are several types of investments available, including cash equivalents, fixed income securities, equity securities, real estate, commodities, and alternative investments. It's important to consider your investment goals, risk tolerance, and financial situation before making any investment decisions. To start investing, you can determine your investment goals, assess your risk tolerance, create a budget, open an investment account, and choose your investments. Investing early and regularly can be important for building wealth over the long term due to the power of compound interest and the potential for diversification to manage risk. It's also important to periodically review and rebalance your investment portfolio to ensure that it remains aligned with your goals and risk tolerance. Thanks for watching. Don't forget to like, comment, and share.